Hey there, everyone. Happy holidays. This is Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in a wintry, kind of rainy Redmond, Washington. We're here at the mid-December, late December, and what we thought through the holiday season was to do a special series called the Top 5 Charts of 2023. And the idea of these top 5 charts and what they mean really comes from, my own process and that of my mentors at the end of the year, really looking back and trying to reflect on what happened, reviewing performance, trying to think about big wins, big losses, good decisions, not so good decisions, and really focusing on how you can upgrade your decision making in the year to come. The great thing about charts is they are a natural report card, right? Your report card is right there in front of you, whether you like it or not. Look at charts of things that you traded, look at charts of the major markets and asset classes that you're following, and there's the evidence, right? You can see when you were right and when you were not. And I hope at the end of this year, you can use this as an inspiration to use the Stock Charts platform, really think about how the markets have evolved, think about your own performance, and hopefully Stock Charts can be a part of that growth for you and your investing process in 2024. With that in mind, I do want to share with you our holiday special is going now in the month of December. If you have never been a Stock Charts member, it is a perfect time to give it a shot because it is a very low price and you can lock it in for the next 12 months. If you like, if you're a current member, you can extend your membership using that special at stockcharts.com/special. Here's a quick promo and get your phone ready. There's a QR code at the end you can scan to get the best deal. Check it out. There it is. So go to stockcharts.com/special. Again, do it today. First, before you leave, hit like, hit subscribe, then go to Stock Charts, check out the special, and then come back and make sure you enjoy the rest of this video. What we're doing here at the end of the year, as I mentioned, the top 5 charts of 2023. If you missed the first one, hit pause, go back to check that one first because it's the S&P 500, probably the most important chart because we talked about each quarter and how it evolved. Today, we're going to talk about the chart that I was asked about a year ago, what's going to be the most important chart of 2023? And I tell you, I both love and hate that kind of question. I love the fact that charts can be a great way to look forward, a great way to think about what's happened and try to, sort of anticipate what may happen next, to focus on trend and momentum and what themes may be important. But I hate the fact that we're thinking 12 months down the road. It's incredibly difficult to do. But my answer to that question, and this is our chart number 2, is the 10-year Treasury yield. On our Stock Charts platform, the ticker is $TNX. We have a series of indexes tracking Treasury yields that come from the CBOE. Just so you know, they're quoted at 10 times the value. So if you see a value like 39.60, that just means 3.96%. That comes from the CBOE, and they quote it because of a certain options contract that's based off of that value at 100 times the yield. But once you can get through that mental block, it makes a ton of sense. I've been doing it for years, and it works just fine. But I answered the 10-year Treasury yield again when I was asked at the end of 2022, what's going to be the most important chart? I said interest rates, and the reason was because 2022 into 2023, it was all about the Fed, right? All about the market struggling in 2022. The fact that, as the market would start to bottom, thinking about the Fed raising rates, think about what that might mean, growth versus value, leadership possibilities, just the fact that things were going to be more expensive, inflation was incredibly, was expanding. All of those felt like very important themes. So with the Fed in mind, I answered the 10-year Treasury yield. I don't know how I would grade myself on that pick. I mean, pretty good because it certainly was an important chart to watch. What's so interesting is one of the biggest takeaways that I thought would be would play out would be growth over value. And as you'll see as we go through this chart, was not particularly successful. And I'll talk about why I think that was. And again, I think this chart tells a great story. So here's what it is. The chart here is $TNX. That's the 10-year Treasury yield. And I'm going back just the last 2 years to give us a good frame of reference, because over the last 2 years, from December 22 to December 23, the 10-year Treasury yield has gone from around 1.4% on the far left side of this chart all the way up to 5% in just under 2 years. And then down to around 4%, which is where we're at here in mid-December of 2023. The second panel down is the ratio of value versus growth. And I'm using two ETFs that track the Russell 1000 Value Index and the Russell 1000 Growth Index. And I'll show you how I set up this chart a little later in the video. So when the line is going up, that means value is outperforming growth. When the line is going down, that means value is underperforming growth, or flip that over, growth is outperforming value, which really has been the story through the entirety of 2023. At the bottom, I'm attempting to just summarize the shape of the yield curve. We have an inverted yield curve still, pretty much through the entire year of 2023. So this is basically the 10-year Treasury yield minus the 2-year Treasury yield. So if this is at 0, like it was midpoint of 2022, that means the yield curve is completely flat using those two particular points, the 2 and the 10-year. If it's above, like if it's at 0.5, that means the 10-year bond is yielding about 0.5% more than the 2-year Treasury note. So we're going to go through this from top to bottom. I'll explain to you what this means, some of the takeaways that I think it tells you, and how I set up this chart at the end as well. So what happened with interest rates? Well, at the end of 2022, the 10-year yield had already gone up quite a bit, right? Bond prices had been coming down pretty aggressively, and we'll maybe look at the chart of the TLT here in a moment. But if you look at the chart, you can see that right here at the end of 22, we're right just below 4%. We're around 3.8, 3.9% as we started 2023. Look at how value had been outperforming growth in the second half of 2022. So if you think about that period, right, sort of the market selling off into the October 2022 low, and then the S&P rallying in the fourth quarter, value was outperforming growth during that whole period. So as the year ended, it certainly felt like the momentum was on the side of value over growth. And given the fact that rates seemed to be heading higher, given the expectation that the Fed would be raising rates, which they indeed did, certainly seemed to me like this line was going to continue higher and value would outperform growth. It wasn't to be, and we'll get into a little more detail on that chart here in a minute. So the chart of the 10-year yield in 2023, I would argue, kind of had three phases, right? The first third, right, if you go sort of January through, really June, July, maybe even into August, the 10-year yield was essentially sideways. We fluctuated quite a bit from around 3.2% up to around 4%. You can see we hit 4% in March and again in July. We got down to 3.2% or 3.3% really a couple times here in the first half of the year. By the time we got to July, August, it certainly seemed like we were now in a new uptrend and that the 10-year yields were going higher. This is as we're talking about the Fed, aggressively raising rates. These are 50 basis point rate hikes each time, each Fed meeting back in this period. We had inflation that had gone sky high, and the Fed with a very hawkish tone trying to bring inflation down, which they eventually certainly have done, not to their bogey yet, but certainly a lot closer than it was. So August, September, October, all of a sudden, I remember talking about literally how high could rates go. I had some guests on the show talking about much higher levels, but I remember the 5% target being thrown out back here, and it felt like a long way away, and it was, but it didn't take long for us to get there, right? Once we broke above 4% really here in August, it only took about 2 more months to us to get to that 5% level. Then, of course, we have the third phase in this chart, which is bond prices rallying, yields coming down, and the 10-year yield going from 5% down to just below 4% in about 6 to 8 weeks, which was a quick reversal lower. So what's fascinating to me, given those three phases, right? Sideways 10-year, increasing interest rates, declining interest rates, value underperformed growth pretty much that entire year. And as a reminder, this ratio is looking at the value index versus the growth index using two Russell 1000 ETFs from iShares. So the line going down through the course of this year basically means that value stocks were underperforming. Now, one of our later top 5 charts, and I forget which one, but it's like in the 3-4-ish slot, if I remember, is talking about leadership, right? And thinking about some of the leadership themes, growth over value, the Magnificent Seven versus everything else. And if you think about what this ratio is really telling you, is that through the course of this year, growth was really outperforming value. And if you look at any sort of year-to-date metric in 2023 about growth stocks versus value stocks, regardless of what cap tier you're looking at, small stocks, large stocks, whether you're looking at different time periods from different slices, chances are growth stocks have outperformed. And that's because of the dominance of those mega cap growth names. The only time you may get something different is with some equal weighted measures, but even those in general have been favoring growth over value. So what happened is during the course that you had rising rates, value stocks were still actually underperforming. And I would say a big part of that is because you had the whole AI craze that happened right around this time. Here in March, you can see value dramatically underperforming growth. That's when you really had the beginning of that, sudden injection of interest in AI. This is when OpenAI, ChatGPT, all of that happens. All of a sudden, anything with any implication of AI anywhere in their business, the thing's going to be ripping to the upside. Value stocks in general, even though a lot of things like Caterpillar have a bunch of AI in their equipment and the way that they're trying to optimize equipment and grow their business. AI is a big part of it, but it was the growthy stuff. It was the companies like NVIDIA and cloud companies like Alphabet and Microsoft that really had the lion's share of the gains related to the AI craze. So value actually underperformed pretty consistently during the course of this year. At the bottom, and I should point out, I think that's a great reminder to me. One of the takeaways and why I think this chart is so helpful to review is even though interest rates certainly are important, right? And even though you can think about what rising rates meant for everything becoming more expensive, right? The reason why inflation comes down is because prices are accelerating less because everything's more expensive. And you know that if you tried to buy a house or buy a car, and I successfully bought a car this year. It was a lot more expensive than the last time I did it a couple years ago, and that's because rates had gone up so much. That's just the reality, and that's what the Fed is doing by trying to make things more expensive, which slows down the economy, which brings inflation in check. And so remember, any signs of economic growth were despite the fact that the Fed was aggressively trying to tap the brakes on that sort of upside momentum for consumers. And certainly in the end, it seemed to work with inflation coming down in that 3%-ish range, still above their bogey around 2%, by the way. The bottom panel, as a reminder, is the 10-year yield minus the 2-year yield. Now, just so you know, that's actually trying to summarize a different chart. The better way to do this, and if there was a way to do this effectively, I think we would try it. But there's this guy right here called the dynamic yield curve. And I found that by going to charts and tools in the upper left corner of our website. In the right column, there are a bunch of really cool features of our platform. And if you go to dynamic yield curve, this is a simple but very powerful illustration of the relationship between the yield curve and stock prices. So this is looking at weekly data going back to the late 90s. And you literally can take your left mouse button and click and drag it to identify any historical period, and wherever you're at, you can see the shape of the yield curve. So here in kind of 2012, we had a very normal yield curve, and you can see that if you can't tell by the fact that it's sloping upwards, we have a little word normal there, just so you know that that's kind of what it should normally look like. The shape of the yield curve basically looks at the yield from the very short-term debt instruments like 3-month Treasury notes, all the way out to a 20-year, 30-year, what would you call a long bond, right? Long-term bonds, long-term loans. So what is that yield curve really showing you? Well, if you think about it, this is kind of how a bank tends to make money. This is why in a normal economy, sort of a growing economy, this is kind of how the yield curve should look, because banks are able to borrow from other banks and from the Fed or the central bank, wherever you're at the short end, right? So this is the rate that they are paying to access funds in the short term. Then they're loaning it out to consumers to to buy things, to take a small loan or take a small business loan to grow a new business. This is basically affecting how consumers are able to operate. And so banks, by borrowing here and lending there, that's how you make a pretty decent living at it. What happens when things get squirrely, which is a technical term, is you have what's called an inverted yield curve. And as we fast forward, you can see here in 2023, beginning of 2023, that's where we were at. Now, what an inverted yield curve basically means is that the short-term rates have come up so much, and of course the Fed has been raising rates, during that period, certainly talking about aggressively doing so. What happens is it's very expensive in the short end, and then the long end has in the short end, and then the long end is much lower. That inverted yield curve is usually a very challenging situation for the economy because it's not how things are able to grow. Everything's a lot more expensive. It's not easy for banks to make money, and it's just sort of a backwards alignment of these different rates. That's why an inverted yield curve is often one of the best predictors of a recession, because an inverted yield curve suggests that the market has overheated, and usually we need a shrinking of the economy to reset before we can continue that cycle of expansion once again. As we continue on, you can see here in mid-December, we still have that inverted yield curve. And as the 10-year yield, which is right around here, has come down from around 5% down around 4%, the short end is still very high. The Fed, of course, has not lowered rates. But if you think about what 2024 may look like, that's how you can get to a more inverted yield, or a less inverted and more normal yield curve as the short end comes down, even if the long end kind of stays where it's at. That's where you get back to that 2012 kind of shaping curve where it's a natural upward slope to interest rates. So we can either look at a shape of a curve like this and look at it over time, or we can just look at 2 points. So here we're looking at the 10-year point minus the 2-year point. We can see the inverted yield curve because the 10-year is below the 2-year, and that's this value right here. Currently, the 10-year note minus the 2-year yield, or the 10-year yield minus the 2-year yield, is about half a percent, or what we say 50 basis points. So what that means is the 10-year yield is actually lower than the 2-year yield. Here's the zero line right about here. So you can see through the course of 2023, we've had an inverted yield curve. It actually looked like it might turn back positive in late October as rates were going up, but that completely changed, and we're right back to that inverted curve. And that's because the short end is still very high, but if the long end comes up enough, that would be a very high but normal shape, and that's been reversed. A couple other charts here, and then I'll come back to this and show you how I set up this particular charts. Other things that I think are derivative to that chart of the 10-year yield is a ratio that I like to look at, and I think I have it here on my Mindful Investor Live chart list. I do. Stocks versus bonds. So one of the things to think about when you're looking at interest rates is what bond prices are actually doing, right? And over the last couple years, and this is 2021, 2022, and 2023, you can see that in 2023, really into the last couple months, stocks have been dramatically outperforming bonds. And I'm just using 2 ETFs for this ratio, SPY and TLT. So if the ratio is going up, that means stocks are outperforming bonds. If the ratio is coming down, which it has since the October market low, stocks are actually underperforming bonds, or bonds are outperforming stocks. Look at the long-term trend over the last couple years. In a bullish year like 2021 and 2023, even in a bearish year like 2022, when investors arguably are getting defensive, stocks have still been outperforming bonds. And even in the last couple months here, as rates have come down, as bond prices have rallied, and as bonds are now outperforming stocks in the short term, the long-term trend, I would argue, is still very much positive, still favoring stocks over bonds. So if you think about that traditional 60-40 split that a lot of advisors and a lot of financial firms have advocated for years, if not decades, it's not been a particularly great thing for investors, only because the stock portion has been outperforming the bond portion over time very consistently. And I think there's even more downside that would need to happen here before I would start getting concerned about stocks and their ability to outperform. Look at how the 200-day moving average has served as support for this ratio a number of times over the last couple of years. That's around 4.5 points here, so a little bit below current level. So I would look for this chart going forward to see if we're able to hold that particular level. The other thing to think about, and I actually put this. Where did I put this chart? Good question. Let me think if I can find it. I actually set up a chart where I was looking at. I think I put it in here. Looking at the S&P 500 with the Fed. There we go. So here I have the S&P 500 monthly chart. So forget about 2023. We're looking back for years and years. I think I'm going back around 30 years to this. And below here, I'm looking at the Fed funds target rate, because the chart of the 10-year yield in 2023 is really talking about interest rates. When you think about the fixed income markets, particularly the interest rate environment, the Fed and their ability to affect monetary standards really changes, and affect liquidity really affects the markets dramatically, the bond markets and subsequently the equity markets as well. What's happened is this is where the Fed started raising rates here in early 2022. As you can see through the course of 2022, it's an aggressive series of rate hikes. This is when the Fed every meeting is going up about 50 basis points as a clip. This is as the market is coming down. This is as coming out of that COVID rally. There's a big concern that inflation was running away from us and that the markets were going to go down to zero, and it was a real dire period. And so as a result, the Fed raised rates aggressively. In 2023, the pace of those rate hikes has slowed down, but we've overall been consistently moving higher. Until these last couple meetings, you can see that line flattens because the Fed is no longer raising rates. The market overall doing pretty well because it's pricing in the fact that inflation is indeed coming down or has come down to more manageable levels. The action that the Fed has taken by making things more expensive is slowing things down in a way that makes sense. Market really, in a lot of ways, pricing in that sort of soft landing, that Goldilocks scenario where the Fed's actions are able to force the economy into a particular trend or particular state. The real question mark, of course, is going forward and looking for if and when the Fed starts to lower rates. We've talked about higher for longer, and if the Fed would keep rates elevated for quite some time. Here's the thing, right? Look to the left as to when rates come down, and look at what happens to stock prices when that tends to happen. It usually is not particularly good, and the reason is because once the Fed has hiked rates like this and kind of gotten things back into good shape, the market can then do better. The economy can start to expand, and unfortunately, when the economy really gets overheated, really gets going again, that's when the equity markets start to price in a future recession, start to price in the fact that the economy is not going to do well forever, and that's when a bear market phase can come in. So going into 2024, the bad news about rates coming down, it's usually not a particularly good thing eventually for stock prices. To wrap up this second of the top 5 charts of 2023, I just want to make a couple comments about how I created this chart. And again, I think the Stock Charts platform is a brilliant way of making sense of these markets and looking at the evidence in equities, in bonds, in other asset classes like currencies, commodities, cryptocurrencies, all of which we cover on the Stock Charts platform. Here I'm doing a simple 2-year daily bar chart with moving averages, and I just set that up as you would normally. What I want to highlight is at the bottom, I have a ratio of value versus growth, and I have a spread of 2 different interest rates. Here's how you set that down. The syntax is using what you see at the bottom here. Just to zoom in a little bit so you can see what I did. There's an indicator called price performance, and this is a really good way to take 2 different things on a ratio basis. So if you're looking at a stock versus a benchmark, 2 ETFs, one versus one another, which is what I'm doing here, you type the first ticker, any ticker will work, and then the colon, the 2 dots, and then the second ticker. And this will be a simple ratio of one versus the other. And you can use either indicator, price or price performance. I like to use this one because it quotes it in percentage terms, which is just a little easier for to wrap my head around. Now, to do a spread between 2 different interest rates, you don't really need to do any sort of performance measure. Just use the indicator called price. Do the first ticker, the minus sign, and then the second ticker. So here I'm using the code $UST10Y, which is the 10-year Treasury yield, minus $UST2Y, which is the 2-year Treasury yield. And if you don't know all those tickers, by the way, it's okay. The good news is any of these charts that I'm sharing, I'll happily share you the link. And at the end of this series, I'm going to publish an article that has all of these charts included, so you'll be able to access them. But just go to the top here and type a ticker, type 10-year Treasury yield, or hit the magnifying glass and type the words that you're looking for, the ticker that you're looking for, and we're able to identify it for you. So this is a great way of illustrating how we can look at a value, a price, we can look at ratios, and we can look at spreads to really understand how different markets and how different asset classes are related, and really think about the change in those relationships over time. So that is the second of the top 5 charts in 2023. Chart number 1 was the S&P 500, probably the most important starting point. Chart number 2, I was asked about a year ago, what's going to be the most important chart of 2023? I think I'd probably stand by that. I mean, it was a good chart of any to really help you understand the Fed, the implications, why the Fed was taking action, what's happened to the interest rate environment, what that's done for leadership. Through the remainder of these top 5 charts, we're going to go through a number of other great ways of using the Stock Charts platform to visualize the markets in 2023 and hopefully set you up for success in 2024. That's it for chart number 2. Don't forget to like this video, subscribe to our channel while you're here. We're almost at 100,000 subscribers, and it'd be great to kick off 2024 reaching that fantastic milestone. Don't forget to go to stockcharts.com/special for our holiday special as well. For Stock Charts in Redmond, Washington, I'm Dave Keller. Be well, stay safe, Have a great holiday.